Hello and welcome to Portfolio Matters, weekly markets checklist week 149. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What have we got this week, Keith?
Well, we've got a relatively light data week this week. And frankly, there's not that much going on in the world, although momentum trades everywhere are doing incredibly well. So Bitcoin had an astonishing week, up 20%, and has surged past $60,000 and is closing in on an all-time high. The big macro data point of the week was US PCE, that's personal consumption expenditure inflation, which came in as expected at 0.3% month on month in January. The December number was revised down from 0.2% to 0.1%, but we will show you the data. Services inflation in the US is persistent and maybe resurgent. The market is worried about the resurgence of inflation. Donald Trump has won in South Carolina and looks almost certain to be the Republican candidate for November's presidential election. European gas prices are back down to pre-war levels, although they've had a bit of a bounce this week. And the EU, thankfully, has decided not to send troops to Ukraine. So this is Bitcoin, an enormous surge this week of 20%, taking its gains to 45% year to date. And that means its price is approaching its all-time high. It's volatile. Now, the IMF has upgraded its forecast for US GDP growth for 2024, and it's downgraded pretty much everyone else, particularly the euro area. US interest rate expectations have risen sharply over the first couple of months of the year, and previously the markets were expecting the Fed to cut harder than the Fed themselves were predicting. Now the two are in line. So the blue line is market expectations for Fed funds rate as the end of 2024, and the white line is the Fed's own prediction, and you can see they're now in line, and that is expectations of 2 rate cuts by the end of the year. The other thing that's getting worse is the drought in West Africa causing an enormous shortfall in cocoa production. I had not realized that we've now had shortfalls for 3 years in a row, and this year's shortfall is expected to be 500,000 tons. So the price of chocolate is going through the roof and frankly is likely to get worse. On to this week's economic data. No change in the outlook, so the UK is weak, showing signs of bottoming. EU is weak and also showing signs of bottoming. The US is strong, but we had been expecting it to strengthen further, and actually the latest data is not showing that. China, difficult to tell. Richard, the UK.
Thank you very much, Keith. So this is UK consumer credit, and which was up a little bit up on expectations, 1.8 billion. So actually nothing remarkable, I would say, about that level of consumer credit.
Yeah,
really. UK net mortgage lending, I'd say that is, I mean, we're hearing odd things about the property market in the UK, aren't we? And it seems, as we've discussed previously, it's somewhat partial, depending on which bit of it you're in. But this is showing that UK mortgage lending is not strong and is not strengthening. UK lending to individuals, that also is showing no signs of growth and is very significantly weaker than expectations. So I'm not quite sure what's going on there. I guess
Well,
people are saying
that's
perhaps they
sorry.
can't feel they can't afford the interest payments.
Well, sorry, Richard. That's the sum of mortgage lending and lending to individuals.
Hmm.
So it's the fact that mortgage lending is so weak is
Yeah,
causing basically the net lending to be incredibly low.
yeah. So basically, net lending is making no contribution to economic growth.
Yeah, that's right. And so the good news is that net lending, that low net lending figure implies very low money supply growth.
Yeah, which is good for inflation. The UK mortgage approvals, though, they are showing signs of a little bit of
Mm,
strength after a rather weak period, and that would come through into actual lending in the next few months.
yeah, absolutely.
UK money supply pretty flat, really. I would say has been for the last year or so. Very little change there.
Yeah. And if you believe in the quantity theory of inflation money, then declining money supply should mean that inflation remains subdued, he says, hopefully.
Yeah, and the CPI distributive trades survey is it's a very noisy one, this, isn't it? But it is still in that sort of downtrend from
Mm,
early 2022 or mid 2022. It hasn't broken out of that trend yet, so we'll have to see what goes on in the next few months.
yeah.
UK car production, as we discussed last week, I think it spiked right up,
Mm,
and now it's fallen right back down again.
yeah. Still on a rising trend, I'd say. It's very volatile month on
Yeah,
month.
yeah. UK nationwide house prices month on month up 0.7%, which actually is a chunky year-on-year increase if that were to be
Mm,
sustained. And year-on-year prices just a little bit up 1.2%.
yeah. As you have pointed out, Richard, this is the index of the price of houses on which Nationwide writes mortgages.
Yeah,
And so there's likely to be a bias towards more expensive houses. And the ONS's own house price index actually shows house prices falling currently.
yeah. The economic surprise index for the UK is actually looking not very good.
Mm,
So this is the Indeed jobs posting index, which is continuing to fall. It's fallen again last week. UK trueflation basically has sort of bottomed out at around 2.6 to
mm,
3%. Labour has this big lead in the opinion polls. I'm not quite sure where. The interesting about is the Reform Party, I think, isn't it, which is cannibalising with Nigel Farage, those who don't know, which is cannibalising the Conservative vote, I think.
wow. Yeah. Well, it looks like Labour are going to have a landslide in November.
Doesn't it just? Yeah. The Lib Dems are doing really quite badly. They're clearly
Mm,
not viewed as an alternative to the Conservatives. So we've got this net mortgage lending, consumers therefore paying off their mortgages, which is good for indebtedness, and good for inflation, good for M4, and maybe there's a little bit of spark in the housing market coming through. The
mm,
labour market appears to be continuing to weaken slowly. I think that's probably true. Just generally getting a sense of what's going on. And the UK economy is not doing well. And we really need a bit of a sea change in
mm.
the way this country is governed, in my view, in order for the UK economy to start to do better. I mean, just the tax take is extraordinary.
Yeah. Well, Labour are going to come in. I doubt very much they're going to be cutting taxes and
Exactly.
reducing services, Richard.
I mean, what do? You have you have a choice between basically what is a corrupt Conservative government, in
Yeah.
my, or a Labour government that is never going to be. I don't think it's not going to be good for business, or a bunch of extreme right wingers.
Yeah. Have you thought of moving to Australia?
Well, I've thought of moving my own private island, Keith. I suppose I don't have one.
Well, I think you just need to get into your boat and sail off, Richard.
Yeah. doesn't really work, does it?
And on that cheery note, on to the EU. EU consumer confidence came in on expectations, slightly better than in January, but still not great. Economic sentiment actually declined. It was expected to rise slightly and it fell. Industrial sentiment fell further. Services sentiment, having improved in December and January, actually fell back, and that is not a good number. Selling price expectations declined to 3.8. That is nothing to worry about and good news for the ECB. And if you look at a breakdown of that number, you'll see that selling price expectations fell for both retail and services, and that is good news. And that should mean core inflation continues to decline in the coming months. Consumer inflation expectations are heading the wrong way, though, up sharply. So although businesses are not expecting to raise prices, consumers are worried about inflation, and that it also shows up in their one-year inflation expectations, which are rising again, which is surprising, as inflation in the Eurozone is definitely coming down. Loans to companies grew 0.2% year on year, not great. Actually, bank lending as a whole fell by 12.2 billion in January. So month on month, lending was negative. Household credit growth going nowhere. Money supply, therefore, going nowhere. Very good news for inflation. Citigroup Economic Surprise Index is positive for the Eurozone. So this is the ECB's own assessment of how its interest rate rises have impacted lending to firms. And so you see the rise in interest rates on the far left chart starts at T0, and you'll see that lending rates to firms rose sharply in line with the policy rate, and credit flows to firms promptly fell sharply. So according to the ECB's own assessment, their rate hikes did absolutely have an effect in curtailing lending to firms. And as the Eurozone economy is doing very poorly, frankly, they're going to get the economy moving again. They'll need to cut rates. Now, and the market believes that the ECB will start cutting in June. And frankly, this podcast agrees with them. And we have Eurozone CPI for February out later today, but we have had some individual country data. And that is all reassuring. So French CPI fell to 2.9%, down from 3.1% in the year to February. Spain fell back to 2.8%. Germany down to 2.5%. So Eurozone CPI should keep falling in February, and that will be good news. So in summary, the Eurostat survey suggests that confidence in both the service and manufacturing sectors actually fell back in February. Household and company lending remains weak. The Eurozone is in stagnation and actually showing little sign of improvement. On to the US, Richard.
So US inflation, PCE inflation, month on month, revised down in December on expectations in January, 0.3%. And year on year, 2.4%, which is on expectations and continuing to fall. So PCE is continuing to undershoot CPI, and CPI has actually flattened off, and PCE is continuing to fall. And core PCE is just a little bit below 3%, but that trend is still downwards. Core PCE ex housing was 0.6% month on month. So actually, that is quite high, isn't it?
Yeah, that is a really bad number.
Yeah. In fact, that's back to the highs of when inflation was transitory.
Yeah.
So that's the question, isn't it? Is it an outlier, one single month, or is it the start of a trend?
Yeah.
Difficult to know.
Well, we talked last week about how inflation in the US does tend to be quite seasonal. Now, I've got another section coming up. So US inflation numbers are seasonally adjusted, but not completely. So it's we'll just have to wait and see, but it is likely that you get a lot of inflation at the start of the year and then it fades over the course of the year.
Yeah. So, and in some service sectors, the level of inflation is actually only just catching up with the rise of prices. In other words, price rises.
So, well, they've seen inflation in the economy of what 20% over the last couple of years, and
Yeah.
you look at professional services inflation, it seems that there's a lagged effect. I mean, there wasn't 20% inflation over the last few years, and now suddenly in legal services and professional services, you're actually getting annual inflation of well above 10%, very high.
So, yeah. So in fact, there's this sort of partial driver of increasing inflation going on as people are trying to regain what they've lost out of over the last couple of years in terms of their pricing.
Yeah. Well, and the Fed will not like that, frankly. It shows they have pricing power.
And this one is sort of similar to our chart, isn't it? It's just showing that goods and energy are in deflation.
Yeah.
In other words, prices are falling.
Yeah.
Rate of change of prices is negative.
And then you notice this chart of calculators, typewriters, and information processing equipment is consistently negative, as the same for televisions. Electronics get cheaper and cheaper.
Yeah. Motor vehicle rentals is a very interesting one, isn't it?
Yeah, had an enormous spike during the pandemic, is now subsiding again.
Yeah. GDP quarter on quarter annualized came in at 3.2%. Expectations were 3.3%. So I would say that in terms of the vagaries of these things, that's a hit. But the US economy is still firing on all cylinders.
Absolutely.
This is the PCE prices quarter on quarter annualized, which is just a little bit below 2%.
Yeah. Good news.
And a core PCE is at, let's say, slightly above 2%. Durable goods orders fell back very sharply in January and revised down in December. So, but it is a very sort of lumpy chart, isn't it?
It is, yeah.
And durable goods orders excluding transport, which is a slightly less lumpy chart, that is showing two consecutive months now of a slowdown.
Yeah, which is very surprising.
Yeah.
Because we have previously talked about the turnaround in the manufacturing PMIs, and actually the new orders component of the PMIs has been rising.
Yeah.
So, once again, I'm just mystified by the complete lack of a correlation between the PMIs and actual hard data.
Yeah, no, I agree, Keith. It's durable goods orders excluding defense.
The monthly durable goods orders are dominated by transport and planes, basically, with huge lumpy orders.
Yeah, I mean, I think it's probably a fair comment, Keith, that an artillery shell is not a durable good.
Good point.
Although, I suppose it depends how long you keep it for, doesn't it, before you fire it? Yeah. I'm sure we should get a statistician's view on this. So in January, the ISM manufacturing new orders index rose above 50. Durable goods fell sharply. So what's going on there? Okay, so the US Conference Board consumer confidence is that's actually looking reasonably healthy, I would say.
Yeah, but it fell back unexpectedly in February. It was expected to strengthen, it didn't. And January was revised down.
But if you look at the graph, it doesn't look, it looks okay, doesn't it, I would say?
Yeah, but again, we've been expecting the US economy to show signs of strengthening, and it ain't.
Yes, that's very true. The present situation, the expectations index is sort of derivative, really, isn't it?
Hmm.
And the expectations index is it doesn't move very much over short periods of time, and secondly, it's much lower than the present situation index, so it's more pessimistic
Yeah.
often.
Yes, that's very true. So consumers feel they're much better off than when this index started in 1985, but
Yeah,
their expectations of how they're going to do in the future is poor.
yeah, yeah. So built-in pessimism.
Hmm.
Perceived likelihood of a US recession over the next 12 months is, well, it's like, read into that
Hmm.
what you think, I guess.
Yeah, but we've been expecting the US economy based on the PMIs, etc., to be improving, and actually, that seems to have stalled.
US case-shiller house price index month on month. Actually, that decline is a fairly continuous trend, isn't it? All the way back to April
Yeah.
2023, and it's just continuing that sort of that trend. So finally, it looks as if interest rates are having an impact on the house price index.
Well, this is really interesting because Case-Shiller reminder is compares the price of existing houses when they're resold. So there's no bias in terms of the makeup of which houses are being sold.
So year on year, is the index
Yeah,
is definitely up.
it is.
US new home sales are sort of 20 pre-pandemic levels, really.
Yeah, no problem with that whatsoever, I wouldn't have thought.
US pending home sales, very noisy sort of chart this, but obviously
Mm,
down in January, up in December.
yeah,
US pending home sales year on year has fallen away from the zero line. Quite a big move.
yeah,
And the Fed manufacturing index still below zero, which from Fed still below zero. Sort of standard monthly move there, really. So it's a
yeah.
couple more months.
But again, the PMIs have been improving, and we showed this last week how the regional Feds surveys were actually quite negative, and the regional Feds turned out to be more accurate than the
Yeah.
PMIs.
And a lot of that, actually, a lot of these are actually significantly below expectations, aren't they? And the services, the Richmond Fed Services Index is much worse than expected.
Yeah, and this is, it's volatile. This is quite an odd number. So, we're not seeing the expected improvement in the US economy
Yeah.
that we were talking about in the first weeks of the year.
So the Chicago PMI, again, worse than expectations
And down.
and down below 50. Johnson Red Book retail sales, 2.7%. The 30-year mortgage rates actually moved up a bit last week, didn't it, I believe? And it's very similar to last week. And the mortgage index market looks like it might be setting itself up for another fall.
Yeah,
US initial jobless claims is there isn't yet a trend there, I think one has to say.
I agree.
US continuing jobless claims, is there the beginning of a trend there?
Yeah, too early to tell.
Yeah. And the year-on-year change in unemployment rate is falling.
Mm. So little sign of a sustained rise in unemployment
Yeah,
year on year.
yeah. The Dallas Fed weekly economic GDP estimator, which is the blue line, well, it's at 1.9% as opposed to 1.8%, but basically it's sort of leveled out at around about just below 2%,
Yep.
around about 2%.
Looks absolutely fine.
Yeah. And the Atlanta now is at 3% this week, 2.9% last week. So again, that's looking absolutely fine. The economic surprise index is above zero. So no cohort of nasty surprises. And we've got the same thing going on with Indeed job postings.
This is concerning.
The pickup in Trueflation.
Yeah.
Yeah. Although,
actually,
if you look at sort of previous moves, like between July and October, the size of the move isn't particularly large. I mean, obviously, if you pick a trend like that, then.
Yeah, that's true.
So, PC inflation came in on expectations, and inflation seems to be continuing to fall in the US. US GDP growth is still hot. Durable goods orders looking very odd, actually, I would say. And consumer confidence falling slightly. But a lot of the data came in worse than expectations.
Yes.
And that is that an indication that people's view of the economy is actually needs to change a little bit? Don't know, but is the economy beginning to slow?
Okay, thank you, Richard. On to China. So we had the National Bureau of Statistics PMIs this week, and if you believe them, the February manufacturing PMI came in slightly worse than in January, but met expectations. Non-manufacturing rose into expansion territory, beating expectations, well up on January. The general, strangely, was unchanged despite that strong beat of the services PMI, and actually worse than expectations. Now, this is an interesting chart. It shows China's share of manufacturing exports over the last 20 years, and it's grown enormously and has become the workshop of the world, whereas manufacturing exports from Germany and Japan have been declining as a share of world GDP. But we've talked about this in previous weeks. The projected decline in the Chinese population is really, really extraordinary. So China currently has a population of 1.4 billion. If current birth rates continue, then it's projected to fall by 65% by the end of the century. And that has really profound implications for the global economy. Now, this is Chinese property sales in millions of units. And you'll see the average is what? 10 million units sold a year? Well, apparently there are 70 million Chinese properties for sale currently. So 70. So it's difficult to see Chinese property prices rising. Historically, the Chinese have been buying properties as an investment vehicle. And the moment the prices start falling, that becomes less attractive.
Yeah.
You know, there will always be some building in different areas, but, you know, the period of rapid Chinese property investment, I think, has come to an end. You'll see that steel prices fell this week. So in summary, PMIs show the Chinese economy not doing very much, frankly. And onto one chart. So since the US has started raising interest rates very rapidly from essentially 0 to 5.25%, you would have expected the unemployment rate to rise as the economy slowed. And in the 1980s, that is exactly what happened. So as you had a curve between a trade-off between the unemployment rate and inflation. As getting inflation down required an increase in unemployment. This time, it's been absolutely extraordinary. core PCE inflation has fallen from 6% to 2% with absolutely no change in the unemployment rate, or barely any. The Beveridge curve offsets the job vacancy rate against the unemployment rate. And what we're seeing so far is that there are sufficient job vacancies that the rise in interest rates has only cut the job vacancy rate because there are lots of job vacancies. And only if the job vacancy rate falls below, I think, 5%, does the unemployment start to rise. And so the slowing jobs market has so far only resulted in fewer excess job vacancies. It needs to fall further before the unemployment rate starts to rise. Now, the US jobs market does appear to be continuing to slow. So if that trend continues, then the unemployment rate may start to rise later in the year. But we've shown you previously the PMIs, particularly in manufacturing, are strengthening. So there seems to be several factors pulling the US economy in different directions. But when you look at the vacancies rate from Indeed, that is continuing to fall. Bottom line, if the US jobs market continues to cool, then unemployment rate should start to rise. Okay, and on to errors and corrections. Now, last week, I did this whole piece on seasonality. And I showed you this chart, which showed in red the monthly averages for US CPI. Well, once again, I need to dig further into stuff I find on Twitter because it turns out this chart used the non-seasonally adjusted numbers. And using the non-seasonally adjusted numbers, you get this strong seasonality. The headline CPI numbers are actually seasonally adjusted in the US and should account for this. And I have therefore downloaded the official headline CPI numbers and looked at whether there's any seasonality in those using the monthly averages for the period 1984 to 2020. Now, if it was perfectly seasonally adjusted, you would just see the trend number. So these numbers would be basically volatile around a standard trend. And I think you see that. You could say that the months early in the year do show some signs of being higher than the rest of the year, i.e. the seasonal adjustment is not quite strong enough. Because these are the non-seasonally adjusted figures, and you can see that there is a very strong seasonal effect. So inflation is high at the start of the year and declines over the course of the year. And this is a comparison of the two. So the orange bars are the non-seasonally adjusted monthly averages, and you'll see there's a strong seasonal effect. The blue line, the blue bars are the official CPI numbers, which are seasonally adjusted. And you'll see there's not much seasonality in them. So seasonality and effects in US CPI numbers can largely be discounted. You may say that the first 2 months of the year are not quite seasonally adjusted enough, but it's a marginal effect. Now, in the UK, CPI numbers are not seasonally adjusted. So there is a strong seasonal effect. And we talked last week about how inflation in the UK tends to fall sharply in January. And then we go into 4 months of quite strong inflation. And inflation on a monthly basis peaks in April in the new tax year. And news out this week was that Marks and Spencer's will be raising its salaries for retail staff by 10% from April. So Bank of England will be concerned that wage inflation persists. Inflation in the 4 months beginning from February last year was exceptionally strong. And we've seen from Truflation that UK inflation remains subdued currently. And if UK inflation just returns to its long-term average, then because we had so much inflation last year, which will fall out of the year-on-year comparison steadily over the next few months, then as long as we don't get a reversion in inflation, then UK is on track to hit the Bank of England's 2% target by June using the May figure. So bottom line is the US and EU CPI numbers are seasonally adjusted. The UK is not. So the UK has strong seasonal effects. And while we're talking about inflation, another further thoughts on US CPI inflation, because we talked about this when the numbers came out. The US housing inflation number was very odd. So we had a sharp rise in owner equivalent rental inflation, which contributed to the high January CPI print, which is odd because we know rents have been falling in the US and are very low. So rental inflation is close to zero or negative, according to some indices. But owner equivalent rent looks at how much a homeowner would pay to rent their house, the theoretical amount they'd pay to rent their house. And the point is that the price of single houses has continued to rise over the past year. And there's a difference between rents, like live rents for apartments in the market, and how much it would theoretically cost to rent a single home, given that house prices are still rising. And if you look at the breakdown of the shelter component of the CPI basket, then OER is an enormous 27%, whereas rents is only 7.7%. So OER is dominant. Now, according to an email from the BLS this week, which they then subsequently retracted, the surge in owner equivalent rent was in part due to a change in weighting within the index, putting more weighting on single family homes. But that implies that owner equivalent rent inflation is much higher than rental inflation. And so the putting more weight on a bigger number led to the rise in OER. So none of this is good news. Single family homes are more expensive to rent than apartments, and the BLS seems to have placed more weighting on owner equivalent rent within the CPI basket. And as the price of single family homes shows no sign of coming down, that is likely to mean that CPI is higher because of this theoretical OER, as opposed to actual market rents, which are declining. Richard.
Yeah, it's interesting, isn't it, Keith? So I heard that, I read somewhere that they make an adjustment to owner equivalent rents by to remove energy prices, energy costs.
Right.
And there's been a sharp fall in gas prices. And by obviously the rent hasn't changed, month to month, rent hasn't really changed, or the calculation hasn't really changed. But then you remove a chunk of gas prices, price drops, and actually the rent suddenly shoots up by the difference.
Ah.
And I heard that that was one of the factors that affected it. I
Okay.
think the problem we've got with it is it's a rather it's a spurious number in many senses,
Yeah.
as we've discussed many times in the past, isn't it? And then why they don't just take rent?
I know. Yeah. So
We're
hence
coming
this
in
big
these
difference. Hence there's this big difference between PCE and CPI inflation.
yeah.
And onto inflation watch, Richard.
Thanks, Keith. So the only new numbers that we've got this week are in Japan, where CPI and core CPI have both fallen. The trend is throughout the developed world is sort of falling inflation.
Yeah, but in Japan, they just can't sustain inflation. They've been doing their damnedest, being fiscally and monetarily irresponsible.
Yeah.
And inflation actually fell quite sharply in January.
Yeah, it's a new model, isn't it? I mean that seriously. It's sort of like their various economic theses have been tipped on their heads by Japan. The UK energy price cap is going to be falling by 12% in April.
Yeah.
And we expect it to fall again in July. This is obviously because energy prices are falling generally, so the cap doesn't need to be anything like the size it was. And you could argue the cap should probably just be done away with.
Well, this is great news for UK consumers, and it's expected to fall further in July. So, that input price into everything, particularly like manufactured goods, but also, the cost of running a restaurant or a pub.
Yeah.
So if that gets passed on, just generally great news.
And in January, over half UK CPI components fell in price, which is, suggests that there's a strong impetus in terms of reducing prices being reducing. It's not just the odd component here and there. It's broad based.
Yeah, great news.
And US PCE inflation, which we've discussed, US inflation earlier, is forecast to return to target slowly over the next 18 months, and most thanks to goods inflation. Although we have seen earlier that consumers are expecting US inflation to increase.
Yeah. Now, the slowdown in PCE services inflation is incredibly slow.
It is, isn't it? And has it bottomed at that point?
Well, this is all forecast from here, but
Yeah. Yes, that's true. Yeah. And the question is US inflation turning back up?
Yeah, absolutely.
We need a bit more data on that. But that's why the Fed is very keen not to move precipitately too quickly, increasing rates. They don't want to get caught out twice. And actually, they're going to come into a window where they won't be able to change rates because they'll be seen as meddling in the election if they start changing rates in the early summer. So they've got a sort of window in which they can, and they have to rather sit on their hands. The average price. Sorry, Keith.
So, Richard, when do you think they're going to cut rates?
I think they might do. I don't think they'll do one in March. I think they'll want to wait.
Yeah.
I think they might do one in April or May, and then I think they may not do any more until after the US elections.
Right. I think it's going to be later. I'm betting on June. I'm betting on June for
the first one.
Yeah, the first one.
Yeah,
and then they don't need to go fast. If I was them, I wouldn't go fast. The economy is doing absolutely fine.
Yeah, exactly. And there's more downside in it for them in going fast than there is in going slowly, definitely.
Yeah.
So price of used Teslas is down 50% from their peak. And even if you look at the pre-sort of COVID maneuverings, it's substantially down from those rates. So who'd want a new Tesla? Is it because service costs are so high?
I think that's part of it, Richard. Also, the cost of repairing these things is really prohibitive. But also, there are just loads of electric vehicles now. So previously there was a premium for them.
Are
But
you
now,
telling me that no one wants them, Keith? So-
no idea, mate. But certainly the shares I think are ludicrously overpriced. But what do I know?
The Mannheim used car index is continuing to fall from that very high point. It's still very elevated though.
They are, but I mean that is 20% down from its peak.
Yeah, and
That's a
still,
big fall. And
yeah,
still falling.
yeah. And the US car insurers are not profitable because of despite the big rises. And the problem they have is that cars are get more and more expensive. They get more and more sophisticated. Car repairs are more and more expensive. And apparently, the number of accidents in the US is going up, and they think it's because of people using mobile phones.
Yeah, we talked about this last week.
Yeah,
Uh,
oh yeah.
but the car insurance premiums, have you seen the UK one, the center chart? Absolutely shocking. 64% cumulative rise in car insurance premiums since 2019.
Yeah, and actually, if you look at it's not really since 2019, is it? It's since 2022.
Yeah, yeah. Frightening.
Isn't it?
So, I mean, the bottom line in the US is that, we've talked about the enormous rise in US car insurance premiums over the last year, contributing to the big CPI numbers. Well, US insurance premiums rises have not been as big as in the UK. And so US car insurance companies are still not profitable. There's still room for them to raise prices further, which is bad for US inflation. Whereas in the UK, it seems we've already had the inflation. It's been absolutely enormous. And thank you to Jaw It for sending us that chart. Oh, actually, so I've got a question for you, Richard. So Kyle Bass, who's like some US fund manager, is in a hotel room in New York. Okay. He orders in-room breakfast. Okay, this is not a huge like blowout breakfast.
Yeah.
It's orange juice, Diet Coke, waffles, and bacon. How much?
Well, I mean, you'd think, wouldn't you? $25 or $30 or something. That's what you'd think. So,
Yeah.
but clearly, it's not that.
No, it's not.
So, I'm not quite
It's
sure,
not that.
but I suspect a lot.
It's $75 excluding tip. I mean, that is just an astonishing number. So what's that? 60 quid excluding tip.
That is a huge amount, isn't it? Goodness me.
Jesus.
That's a Diet Coke for breakfast. I wouldn't go for that.
I wouldn't go for it. Unless you're cleaning some copper coins, I wouldn't drink it at all, mate.
Yeah.
Anyway,
Oh well.
$14 for an orange juice. Jesus Christ.
$26 for a waffle.
I know. And I bet your heritage bacon was like 2 or 3 slices.
Yeah. Exactly.
Anyway, that's inflation.
So inflation can be subject to strong seasonal effects, and it's not clear yet whether the recent uptick in US inflation is a resurgence or seasonal, and inflation in the UK and EU also continues to decline.
Now, so this cycle, obviously, I've got completely wrong. I was expecting the strong rise in interest rates from 0 to 5.25%, or Foxy rate in the US up to 7% to kill the economy. And that absolutely hasn't happened. So why hasn't that happened? Well, John Authers at Bloomberg was talking about this, and he was pointing out that the Fed did not start raising rates until inflation in the US had actually pretty much peaked. You remember when we first started doing this podcast, how all the narrative was that inflation was transitory and the Fed believed its own rhetoric. And so the white line here is the Fed funds rate, the blue line is CPI year on year. And his point is that because the Fed was so slow to raise rates, it gave everyone the chance to lock in cheap borrowing, particularly big US corporations could issue bonds at very low rates and lock in cheap funding. As a result of that, US companies, they have not suffered at all from the rise in interest rates, particularly big ones. So this is their interest expense has actually fallen over the last few years as the US has been raising rates and is unchanged from 20 years ago.
So that's another reason why these increase in interest rates hasn't really affected the economy, isn't it, Keith? It hasn't damaged businesses.
Yeah, precisely. Actually, they're earning 5.25% on their cash balances, and they've locked in, funding at 2.5%.
Yeah. So the only people it's hurt are people who wanted to buy a property and
Yeah.
didn't already have a fixed rate mortgage that they couldn't roll over.
Or, well, anyone who's exposed to variable rates. So, US small businesses who need to borrow from the bank because they can't issue bonds, or consumers who borrow from, finance companies, they're all getting stuffed from the rise in interest rates. The big corporations have done very well. And his other point was that disinflation, which is what we've got now, tends to be very good for GDP growth. It's because I suspect that it's associated with interest rate cuts. And so, given that we now have disinflation and the Fed is expected to start cutting rates, we've talked about this previously in, I believe, June, then actually the US economy can be expected to do better than average over the coming year, in part because companies tend to boost productivity in periods of disinflation because they can no longer just try and raise their prices. So in summary, the Fed was so slow in raising interest rates that US corporations locked in cheap funding and are now basically unaffected by the rise in interest rates. So interest rates will have to stay higher for longer in order to reduce their demand. And onto Nvidia, Richard.
So is this a parabolic chart? Question. So we have a trailing earnings, trailing 12-month PE ratio of 65 and a forward PE ratio of 37. I mean, it's priced for growth to continue, isn't it?
It is, yeah.
Clearly these things don't continue forever, or the world would be a computer chip. But it has got an extraordinary grip on a very fast growing market.
Yeah, well, the revenue growth has been absolutely amazing. So it's forecast to have 24 billion in quarterly revenues in the next quarter. This is just amazing. From like 6 a year ago.
Yeah. Year on year. It's growing at 265%. Of course, it's only done that for a short period of time.
Yeah.
And whether it's replicable, remains to be seen. But it's hard to say that this share is a sell at this point.
Well.
Yeah, profit margin 56% because doesn't have much in the way of competition.
Yeah.
That's his net margin.
But notice historically how volatile it's been. I realize this is not, it was previously saying graphics cards mainly to gamers, game companies, but
we have a chart of its annual revenues. Well, it's massive, isn't it? As Keith says, and it's growing incredibly fast.
Yeah, but I mean, the point is, Richard, that in 2024, its revenues, so it's year to January. So the year to January 2024, its revenues are about 60 billion. in 2019, the whole industry had revenues of 400 billion.
Yeah.
It's just absolutely amazing.
So it's an industry that's growing incredibly fast, isn't it? I mean, I find AI a slight digression, but I find AI. I'm not sure where it's really going to go, and how
Yeah.
much of this is speculation on the part of people who say let's use AI, it's going to be fantastic, and are investing in it. And I'm not sure how successful that investment is going to be.
Yeah. Well, where can you say who's buying AI services? I
So
can't see.
I sold something on eBay. Well, I haven't sold it yet, actually. I put it on eBay the other week. I described it as used. It's a bit of marine equipment. So I put it on for £120, right? Which actually it turned out was significantly overpriced. And I said, it's been used, it still works. And they said, would you like the AI description? And I said, well, okay. So I had 3 lines of superlatives about this piece of equipment, how it would keep people safe. It was wonderful. It was absolutely fantastic. You couldn't buy better on the market. I thought, this is bollocks. This is utter drivel.
Yeah.
So, I used AI and I said, no, thank you. And I deleted it and reinstated what I wrote.
Yeah.
And so my question is, how much of it is gross nonsense, but a very expensive nonsense?
Well, exactly. I mean, I suspect, like every other technological revolution, it will take quite a long time for the actual productive uses of AI to be
Yeah.
discovered and then implemented.
Yeah. Did you know, you could probably tell that I am, in fact, an AI avatar here.
They haven't done a very good job on your face.
Thank you, Keith. And okay, this is, as we all know, I mean, this is a single Nvidia Tesla A100 GPU, costs around $9,000, and its average sort of useful life is what Keith?
I've no idea, but you need, apparently I was reading up on this. You need about 8 of them for, a server or something. So, yeah, they sell these boards with 8 of them for about $200,000. So, I mean, my point is that the price of an existing GPU, according to history, should fall by about 25% per year. So GPU, floating point operations per second per dollar, double every 2.5 years. So in 2 years, the price of the existing GPU should halve, is basically what I'm saying. And so Nvidia will have to keep on innovating in order to maintain their revenues.
Yeah. And other companies, I mean, Google is trying to develop an AI chip, aren't they? And I think Sam Altman at whatever his business is called, that bust up was about the development of an AI chip. So Chameleon Capital calculated that to justify the price of $700 per share, Nvidia needs to maintain profit margins of 50%. And you can see they're oscillating between 12 and 37%, but that's an oscillation. It's not so 37%. Its current margins are a function of this extraordinary demand we've discussed. Gross sales from their current 60 to 600 billion a year in 10 years' time, which is quite a lot, really, Keith, isn't it? That suggests that they're priced a bit like Tesla are.
Yes. Yeah. So basically, there's price for growth to continue forever. So, in 10 years' time, they're expecting Nvidia sales to be equal to the entire global chip market now.
So, Keith, I think the message we're giving here is that people should go out and short Nvidia. Is that right?
No, it's not. But, I think they should just be wary of, essentially, the moment the sales growth starts to slow, Nvidia shares take a dive. And basically, this Chameleon Capital, this was like from 2 weeks ago, share price now is 790.
So do not short. We're not saying to short Nvidia.
We'll never say short anything. Tesla is a object lesson in why you never short. I mean, we showed you the chart earlier of how it's got no pricing power. Its revenues declined last year,
Yeah.
and it's still on some absolutely ludicrous PE multiple.
Yeah.
And onto recession watch. So this is UK bankruptcies. That is not a good chart. And in the EU, there's just no Germany's doing badly, and there's no indication that it's actually starting to recover. So when you look at the employment barometer, it's continuing to fall. And in the US, we talked earlier about how large US companies were not being affected by the rise in interest rates. Well, US citizens are. So in order to maintain their consumption, they have been cutting their savings rate and running down their excess savings from the pandemic and borrowing on their credit cards. And so the red line is the outstanding consumer credit on credit cards. And that means their debt servicing costs have gone up very sharply, because we've also discussed how the interest rate on credit cards is pretty much at an all-time high. All of that means that current spending levels are increasingly unsustainable. And as a result, credit card delinquency rates are rising. And auto loan delinquency rates are rising. And that is a very worrying sign, because generally the auto loan is the last thing people default on. They need their car. Delinquency rates on multifamily housing are at an all-time high, higher than in the GFC.
Wow.
Odd. Now, we've talked many times about the problems in commercial real estate in the US and worldwide, and in offices. Now, this very attractive building is 360 Park Avenue South in Manhattan, New York. And this week, the Canadian Pension Plan Investment Board sold its 29% stake in the building for $1. It had already invested $71 million in the refurbishment of the building. But by selling its stake for $1, it avoided a commitment to invest a further $46 million. So it has lost an awful lot of money on that building. The office vacancy rate in the US, Goldman are forecasting it's going to continue to rise, actually, over the next 10 years. So that problems in commercial real estate and offices are only going to get worse. Now, this is railroad traffic in the US. And despite the very strong US economy, actually it's lower than pre-pandemic levels. And it's weakened recently, although there's strong seasonal effects.
Yeah.
And thank you to Magnets for sending me the data for this. This is UK housing starts. Really interesting. So you see this big spike in the Q2 last year was due to people starting lots of properties to get in advance of the latest environmental regulations. But since then, there has been a very sharp drop in housing starts in the UK. So in summary, there currently is very little sign of the expected upturn in the global economy in the hard data. In the soft data, perhaps, but not in the hard data. And on to soft landing watch, Richard.
Thank you, Keith. So US consensus growth forecast for 2024 keep on rising. We've now got 1.9% as the consensus growth forecast. So that's significantly up from where it was 9 months ago, 6 months ago. And the decline in cardboard box deliveries has stopped. So that is, and it's stopped quite dramatically, really, hasn't it? It's bounced right back up to 50, suggesting quite a lot of shipping activity.
Yeah, well, so the year-on-year change has just crossed zero. So it has fallen a lot, but now it's stopped declining, is all you can say. But I really like data like this because, this is, hard evidence of how much goods are being shipped around the US.
What's interesting is the global manufacturing PI and this cardboard box measure seem to be reasonably well correlated, except for the recent big decline in the cardboard boxes.
Yeah, yeah. The PMIs just don't seem to have been a very good guide to anything recently, frankly.
No, I think that's right. Yeah. US homeowners locked into very low rates during the pandemic, and foreclosures remain very low. They're sitting pretty, really, aren't they? They don't really care what happens to interest rates.
Yeah, although we did see, the number I reported earlier of delinquencies for multifamily apartments. I mean, the absolute number is very low, but it's still spiked up very sharply.
And we've got companies increasingly mentioning green shoots and bottoming in earnings calls. So that is obviously in contradiction to consumer expectations.
Yeah. So again, we've, in the hard data, we're not really seeing much of an upturn yet, but
Yeah.
companies are confident it's going to come.
So this is the Bloomberg US Corporate High Yield Bond Index spread. And what it's showing is that the spread is back to very unconcerned normal level, which shows bond markets are not concerned about possible defaults in US corporate bonds.
Yeah.
And the easing of financial conditions over the past 4 months has been one of the largest
Yeah.
in recent decades. It's dropped very quickly down to that level it's currently at now.
Yeah. So, that fall in bond spreads is part of the easing of financial conditions.
Yeah. US air travel 7-day average is 8% above 2019 levels, so pre-pandemic levels.
The fall in 2020 is really extraordinary.
Yeah. And Goldman Sachs forecasts no landing. In other words, GDP is going to start growing from here, or from Q2, actually. And only 4% of US fund managers expect a recession in 2024. So people are really, in the financial world, people are really very optimistic.
Yep.
And everyone is continuing to expect a soft landing, except the US consumer.
Well, yeah, actually, that is true. Yes, that's true.
But we don't know how predictive they really are.
Yeah. Okay, thank you, Richard. And on to US new housing starts and completions. Now, reminder that US housing starts, as we showed you previously, have held up astonishingly well, given terrible home affordability in the US, as house prices have net risen over the last year, and we have very high mortgage rates. Now, on Twitter, I saw this. So the dark blue line is houses under construction, and the blue line is new homes sold. And so the implication is that there's an enormous housing glut coming down the pipeline. So far more homes are being constructed than sold. Is that true? So let's have a look at housing starts and completions, total units. So the blue line is starts, red is completions, and the two are very well aligned. So, most houses that are started are completed. We look at single family units, you'll see, and there's a sharp drop in new starts last month, which may be weather related. Very few 2 to 4 family units are being built. Those are currently out of fashion. Now, apartment buildings is interesting. These are starts. You see, actually, new apartment building starts are well down over the course of the last 18 months and sharp drop in January. So there, at least, the rise in interest rates seems to be having an effect. And what's very interesting is completions surged. So you're seeing lots of completions, not many new starts. But is that chart right? Are we now going to see a glut? Well, the blue line is new homes started, all units. The red line is new homes sold, all units. And you see there's always been a gap. So, and the current gap doesn't seem extraordinary. So, no, I think is the answer. And on to other charts, Richard.
Thank you very much, Keith. So, have we passed peak vegan? Well, I know I have. Beyond Meat, which, if you remember, was one of those fantasy stocks that sort of took off extraordinarily, and you could have made a great deal of money out of it if you were very lucky.
Well, this is the danger, Richard, of extrapolating very strong growth, and expectations. The share price absolutely shot through the roof, expecting this very strong growth to continue. Well, it didn't.
And there we have the Beyond Meat share price. It's going to go bust, isn't it?
Declining sales is never good for a business.
Oh gosh, look at that. House price increases caused by low interest rates. We've got the central bankers to thank for this, haven't we, Keith, if I remember correctly?
Yeah. The trouble is that, all asset prices are downside inflexible, particularly when you've taken out a lot of debt. So buying a house with a huge mortgage, nobody wants to sell if it,
you can't afford it, can you?
Can't afford to sell it. So, that all means that house prices are incredibly unaffordable, and that's really bad for society. Young people need to buy a house, and people need to be able to sell their house and move around the country for different jobs. It becomes very difficult.
I mean, we're creating this underclass of people who will never, and we've always had it, but at least, with the destruction of council housing, we've created some underclass of people whose aspirations to own somewhere can never be fulfilled. And as you said, that's very destructive to society.
Yeah.
We shouldn't have done it.
Well, it's zero interest rates, mate.
I know. And that, yeah, well, it's like, don't get me started moment, Keith.
Well, on to good news. So this is a map of the US showing the age of the forests. And if you look at the southeast, in the past century, they have reforested 15 million hectares of land, which is absolutely astonishing number.
Fantastic.
That's an area the size of England.
Yeah.
And actually, that's had an unexpected effect. So that actually the southeast has net cooled over the last 50 years because trees transpire, and so they're taking water up from the ground and releasing it to the atmosphere, and that cools the surrounding area. So, yeah, good news. And on to equities, Richard.
Thanks, Keith. So a very poor week last week, only up 0.2%. Year to date, 4.8%. That sort of inexorable rise in the FTSE All World Equity Index continuing. And FTSE All Shares really not participating in this, is it?
It is, yeah. Yeah, well, the UK, the All Share is really not doing well.
No. The Euro Stocks Index is doing well. And the S&P 500, as we all know, is doing very well. Up nearly 7% year on year. The NASDAQ up over 7% year on year.
Yep.
And the Russell 2000 is very slightly up, but it's pretty almost flat year on year, actually.
Yeah, but it's had a good week. Actually surprising.
It has, hasn't it? Yeah. Bit of optimism creeping back in.
Yeah.
There's the Hang Seng, which is down 3% nearly year on year. Not a very good week. And sort of continuing that long-term downtrend. The Topics, however, is rising quite hard, 14.5% year on year, Keith.
Yeah.
Bitcoin, 45% year on year,
Yeah.
20% in the week.
Absolutely. I read the Michael Lewis book on Sam Bankman-Fried and FTX, and I have to say it was absolutely hilarious. But
Hilarious.
yeah, it's very funny. The level of dysfunction. But I still don't see a use case for Bitcoin apart from drug dealers, money launderers, and speculation. So staying out.
Fair enough. And speculators are the longest they have been since the last time. Bitcoin has these big troughs and then big spikes, doesn't it? And each trough is higher and each spike is higher. And this is suggesting that maybe the current spike is reaching a crescendo.
Yeah. Well, these momentum trades, eventually the momentum turns around. Might not be yet, but
So I read something interesting yesterday that what is the cost for these the Bitcoin miners who confirm the chain? What is the cost? Never mind the utility. What is the cost? And the cost is currently, I think, around about $20,000 in terms of confirming. It costs you $20,000 to earn one Bitcoin, something like that.
Right.
But there's a halving coming up where the number of Bitcoin earned for every successful completion is halved. So it's going to go to something like $40,000 per. It'll cost you $40,000 to earn a Bitcoin, which, as I say, ignoring the utility means that there's a floor, a constant floor underneath, or probably a flexible floor underneath the price of Bitcoin.
Yeah. I know all this, Richard, but ultimately it's what people are willing to pay for it. In the case of FTX, their coin, is it FTT, was worth, a lot until one day it weren't. In the case of it, just in 2 days, it went from whatever to zero. And the firm did that as well. So,
I agree. What is the tangible value of it?
Yeah.
It flows into Bitcoin ETFs. This is the other thing that's caused this bump, isn't it? It's the Bitcoin ETF has opened, rising, while those into gold are falling, which is to my detriment, in fact.
Well, this is another one of those dodgy charts, basically. So the Bitcoin blue line, that is the axis on the left. The gold ETFs axis on the right. So yes, they're falling, but flows into gold ETFs are still higher than those into Bitcoin ETFs. It's all relative.
Yes.
But one's rising sharply, the other is falling.
Yeah. Okay, the pound is not really moving against the dollar. I mean, we've talked about this last week. The dollar index is basically in this fairly broad 107 to 1 range, and the pound sort of sticks in there. There we have the euro. And there's the dollar index, bang in the middle of its range at the moment. There's the VIX, which is just nice and low because the equity market's going up. This is the panic euphoria index, now known as the Levkovich index. And so as Keith has marked here on the left, euphoria is at the top range of sanity. I like that.
Yes.
But not bubble-ish. Yeah. The bond market started to price out Fed cuts, but the equity market hasn't.
Yeah. So, you'd expect, we've talked about this previously, how there is a correlation between higher bond yields and lower PE ratios, but it's quite a weak link. Well, so far bond yields have risen, but PE ratios have not fallen.
Fund portfolios carrying a record tilt towards momentum. So basically, all of these funds are jumping into the Magnificent Seven rally, and which makes momentum far more popular than it has ever been.
Yeah, dangerous,
Yeah.
crowded trade.
And this is, the rally has been quite broad-based, actually. So we've got magnificent Mag 7, S&P X Mag 7 still up over 20%, etc. So it shows that the equity markets are rallying generally.
Yeah, that's since their lows last October.
And breadth has been good.
Yeah.
This is the total return in percentages from late October up until late February. And basically, you didn't want to be in energy and utilities.
Yeah, but every sector's up. It has been broad.
Yeah. The NASDAQ index market cap change year to date is mostly almost entirely due to the magnificent fall. And we've got earnings expectations for the S&P 493 are really not going anywhere at all. They're flat to down. But big tech, they're significantly up. We've had quite a number of downward revisions to the S&P earnings projections over the last few months. So we've definitely got a bifurcation there.
Yeah, absolutely. Now, previously we have talked about equity market concentration in the US, and I showed this chart, which last week, which seemed to show that 75%. So the 10% top 10% stocks in the US were 75% of the entire US market. Now, note that's the top 10% of stocks, and that is pretty much an all-time high. Is that anything to worry about? Well, point one, the top 10 stocks in the S&P 500 as of the 15th of February were about 32% of the index. So that's 10 stocks rather than 10% of stocks. And if you look at international comparisons, that's really nothing to worry about. If you look at the top 10 stocks in the US, that's only 25% of the total stock market. Elsewhere, you get much bigger numbers. UK, 36%, France, 56%, Germany, 57%, Switzerland, 72%. So the US is not actually that concentrated. And if you look at the US's share of total global market capitalization, yes, it has risen very strongly over the last decade, but actually in the 50s and 60s is much higher than it is now. It was much higher than it is now. Another thing to note is that McKinsey claim that there's an inverse relationship between liquidity and market concentration in the US. So low liquidity equals high concentration. So basically what they're saying is when liquidity conditions are poor, then the broad mass of stocks struggle and you get a wider rally and less concentration when liquidity conditions are better. So bottom line is, it's not clear that equity market concentration on its own is anything to worry about. And the current high levels of concentration are partly the result of cyclical forces and low liquidity. And on to commodities and summary. Energy, generally a good week, actually. Oil was flat, natural gas and coal both rose. Uranium fell. Industrial metals, not great, mixed. Iron ore and copper fell, nickel and tin rose. Precious metals, gold up slightly, PGMs just continuing to collapse. So energy, this is Brent. It is down slightly on the week, but WTI up slightly on the week. Numbers specific to the oil market, well, a slight draw in the US. So US crude inventories fell. Crude production was stable at all-time highs. and the Baker Hughes rig count up 6 and now up on the year. Okay, so this is really interesting, possibly the most interesting chart we have this week. Now, this is really dense. You need to pause and take a look if you're interested. But OPEC obviously have this production cut agreement. But what matters to the world market is not production, but exports. And this shows exports month on month. And you'll see that Saudi Arabia actually increased its exports by 500,000 barrels a day in January. And the OPEC 9, despite all their cuts rhetoric, their exports actually rose by 1 million barrels a day, just over 1 million barrels a day in January. And overall, OPEC Plus, their exports rose by 1.3 million barrels a day in January. So production cuts, yes, but their exports rose. And the fact that Saudi Arabia increased its exports by 500,000 barrels a day, does that mean, is that a sign of frustration on its part? We showed you this chart previously about production, showing cuts in production, but actually the export numbers show a completely different picture. Oil demand this year looks fine. Above 2023 levels, demand is not weak. But US implied oil demand is weak. You talked about this previously, how cuts in driving due to EVs and reduction in commuting has led to a drop in US oil and gasoline demand. And you can see that very clearly here. And this is gasoline demand. When you look at global spare capacity, the fact that OPEC have got 3 million barrels of spare capacity means that global spare capacity is high by the standards of the last couple of decades. And, you know, OPEC's in total control. The other way to look at this is there's a glut of oil and OPEC is keeping the price high. But the majors are not investing. This is their exploration spending. Not great. And so, you know, currently we have a lot of oil, but if we are underinvesting in exploration at some stage, then new projects will not come online and the market should tighten. And pause, take a look. This is analysis of North American crude production for 2023 and essentially confirms that the US production grew to a new high and that every category expanded compared to the previous year. In Europe, natural gas prices had a bounce last week, but are still down 22% on the year. In the UK, similar picture. In the US, also a bounce, but down 25% year to date. Now, in the US, we've got lots of natural gas in storage due to a mild winter and lots of production. And that means everyone's bearish and hedge funds are all short. Now, what's the outlook for natural gas? Well, I'm afraid it's not good. Qatar currently produces around 77 million tons per annum of LNG. It is planning to increase production to 126 million tons by 2027 and then 142 million tons by 2030. It's recently made enormous new discoveries in the North Field. And as a result of recently announced projects and Qatar's increased LNG capacity, the LNG market is expected to be in surplus for the coming years, although a deficit is expected to develop from about 2027. By 2035, we're expecting a deficit of between 100 and 110 million tons per annum, according to McKinsey. But there are around 1,000 million tons of potential projects in the pipeline. And this is their analysis of the cost curve for that new capacity. Notice that Qatari LNG is the cheapest because its gas costs is negative, i.e. they make so much money from the associated natural gas liquids that the natural gas itself is effectively free. And all that adds up to oversupply in the LNG market. That is great starting in 2025, i.e. next year. And that means hopefully cheap gas prices for Europe, good for inflation. This is the coal price, had a bounce up 10% on the week, still down 10% on the year. This is uranium. Has it peaked, Richard?
I think so, Keith. Having a rest.
Onto industrial metals, Richard.
Thank you, Keith. So, aluminium, not much movement last week. Cobalt, yeah, nothing to say really.
Yeah, dead.
Copper in its range. Chromium, iron ore falling quite a lot, quite a chunky fall, 17.5% year to date.
Yeah.
Lithium is flat at the bottom, I think, of its rate of its that precipitate fall that it's had. Neodymium, lovely head and shoulders pattern there. Possibly got further to go. Nickel rising a bit.
Yeah, which is surprising.
And this is showing that there's lots of nickel coming out of Indonesia. So one wouldn't expect the price of nickel to rise terribly much.
Mm.
We've got forecast rising production in nickel for the coming years. Obviously, nickel is important in electrification, batteries, and in steel manufacturing. But looks like there's plenty of it around for a while.
Yeah. Well, Indonesian nickel production is expected to double between 2022 and 2030. There's a lot of it coming.
Yeah. And S&P Global expect the nickel market to remain in surplus until 2027. And I mean, these are the companies that are exposed to nickel. I guess some of them are more exposed than others.
Yeah.
Norilsk Nickel presumably is very exposed.
Yeah. Yeah. No, don't. The next 3 years are not going to be good for the nickel price, basically.
Yeah. There's tin, which is having a bit of a run up over the last few months. Ferrovanadium and zinc is this long-term range. And precious metals. So gold very slightly up on the week, virtually unchanged on the year. Flirting with all-time highs. Silver is in this range that it's been in for quite a while now, and it's moving within that range, unexcitingly. Platinum is not looking great, I have to say.
Yeah, whole PGMs look dead as a dodo, frankly.
Yeah, they do, don't they? Rhodium not looking good. Palladium not looking good either. Look like they might have 22% year to date, 3% on the week. Looks like it might be heading for another fall.
Well, that downwards drift is just intact.
Yeah.
Okay, thank you, Richard. On to bond and interest rates. So this is the UK yield curve. Yeah, given that UK base rates are 5.25%, long term, the market is not factoring in big rate cuts.
No.
And this is the US, again, very similar. This bond markets are pricing in the persistence of inflation. Now, we've talked previously about how long-term bond yields are a function of expected interest rates over the period, the duration of the bond, plus a risk premium, the term premium. And this is an estimate of the term premium, and you can see it's negative. So bond investors are paying a premium for long-term bonds, presumably for safety. And that's important because what it means is if interest rates do come down, then bond yields should follow. And in the case of the UK 2-year, so in the bond market is expecting, given that current interest rates of 5.25%, over the next 2 years, UK interest rates to average just under 4.3%. So they're pricing in just over 3 rate cuts. Given that UK economy is stagnating, and inflation is coming right down, and we are expecting it to hit the 2% target by June this year, I think that is pessimistic. I think interest rates are going to come down in the UK. This is the 10-year, not doing very much. 30-year, not doing very much. This is the US 10-year, again, similar story. German bond yields, that's surprising given the Germans economy is doing poorly. They're committed to a hard black fiscal deficit. And inflation in the Eurozone is very much coming down. I'm surprised that the German 10-year bond yield continues to rise. Italian, in contrast, going nowhere. Greek going nowhere. Concluding comments. Well, we have been predicting the US economy would strengthen. Actually, there's very little sign of that currently in the hard data. And the February data has all coming in a bit below expectations. In the UK and the Eurozone, the economies are pretty much stagnant and little sign of a sustained recovery. Richard, what have you been up to this week?
So I have been up to not very much, Keith. I have to say, I didn't confess to this because it was very politically incorrect at the time. But I did maintain a small cryptocurrency. Yes, I just kept a bit of it. So I've been watching with interest as the prices do their usual sort of go parabolic. And then my decision, it is very small, I have to say, and I'm not adding to it, but I'm not going to sell it either. I have decided I'm in this one now for a few years.
My God.
And I just see what happens. But I think it's quite exciting and it's quite fun. But it's like it doesn't make any difference fundamentally to anything, but it's quite nice. So that's piqued my interest in the last couple of weeks. Oddly enough, though, Bitcoin was up 40% year to date. I didn't keep any Bitcoin.
So what have you got?
I got Ether. And something called Solana. And anyway, so they're just I think basically they all tend to follow Bitcoin's trend, and if Bitcoin is going down, pretty much, I mean, I'm not no expert, everything else sort of languishes. So that I'm sort of looking on in frustration at the precious metal miners as the price of gold settles at this around this sort of high level, and the miners languish. But I'm sitting with it, and obviously uranium had a bit of a pullback as we saw on the graph, and that's affected the uranium miners. So I would say that Bitcoin has been a bright spot in my universe, and the rest, the precious metal holdings, which I do via an ETF, they're fine. But the mining companies, both uranium and precious metal miners, are not great. And I've got a couple of little copper miners because the price of copper is going nowhere, and I'm sure it will go somewhere. at some point in the future, probably after I'm dead. So my children will benefit from it at this rate. So fairly tedious. Keith, how about you?
Well, I'm delighted to report I had a better week, Richard.
Excellent.
Up 4.4%, still shit, but
Yeah, but
better
moving
than
in
it
the right
was,
direction. Yeah.
going in the right direction.
There was a big jump, wasn't there, when the US inflation data was announced?
Yeah, it's giving back some of this week, but it's frankly, if we look at T68, which is like the longest duration bond I've got, I mean, is that forming a bottom? I mean, frankly, inflation expectations, implied inflation over the next in the bond over the course of to maturity, 3.3%.
Yeah.
I
I mean,
think that's just way too high. So
yeah.
I think, go on.
I was going to say, I think the inflation expectation now is, I don't know what it is exactly, but probably 2 to 4%, isn't it? The inflation expectation in 2044 is anybody's guess.
Yeah.
So really, this thing is driven off what people think is going to happen over the next few years, I guess.
Yeah, no, absolutely. But the basically everything is correlated with short-term interest rates. So
Yeah.
2-year, this follows the 2-year. It's amazing how the price of the 50-year follows the 2-year. When the 2-year goes up, the price of the 50-year goes up. Theoretically, there shouldn't really be much change.
No.
So when the Bank of England starts cutting interest rates, then I expect this to start doing better. I mean, obviously, this has been an absolutely disastrous trade so far, but inflation absolutely is coming down. And the next few months are going to be crucial. But you've seen from Trueflation that really UK inflation there isn't any. So,
Yeah, no, you're quite right. That is the case.
So hopefully I will escape from this trade skin intact.
Well, I'm keeping my fingers crossed for you, Keith. I'm sure you will. I know it's been very frustrating.
Yeah, well, okay. Well,
and stressful.
Yeah, and stressful. Anyway, we keep going. So thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.